Greetings, traders. Coach Robert from TopStep here. I wanted to put together a little slideshow as an introduction to myself, my coaching style, and the trading philosophy, and a few points that I would like to share with you about how to trade intraday futures, specifically related to TopStep. So I'm going to go through them pretty quickly, and this is just kind of off the cuff, so there may be a couple mistakes along the way. Nice casual conversation, so let's get started here. First of all, we have our obligatory CFTC risk disclosure that we need to make sure that we display on the screen. Okay, and without further ado, let's move on. This is a brief little introduction. Let's move my picture off to the side here of how I got started in futures. And first of all, I started trading low cap stocks in 2017, looking at these breakout plays and momentum plays at the market open. These are low cap, low flow stocks between like $3 and $10. Um, get them up on the chart, see what catalysts are going on, see what float is available, see if there are any shorts available, look for momentum that was happening, volume coming in, and then trying to jump on it with a whole bunch of shares and make some money out of it. It did not work very well. I had about 8 months of solid losses, solid day after day, week after week, month after month. That's how I started. Um, I switched to futures in February of 2018, and this is due to another trader in the low cap stocks and in the chat room in there. He just messaged me privately one day out of the blue and said, "Listen, I'm $1,000 a day trader, and I think you're a sharp guy. I think you know trading. I think you got a lot of effort, a lot of energy put into this thing. I just think you're trading the wrong stuff." And he's the one who introduced me into futures. Never took a dime from me. Don't even know his full name, his real name, just a screen name, and I am forever indebted to this gentleman. He spent about 2 months with me showing me the ropes of what futures was all about. And about 3 months later, I had recovered everything I lost over the past year or so trading low cap stocks. And that was back in April 2018, excuse me, when going to full time. It's been great ever since. Never looked back ever since. And for the record, today is November 28th, 2023. I'm currently 54 years old, been full time over 6 years now, and I absolutely love it. I can't imagine doing anything else. The context here in this quick video presentation is exclusively focused on intraday futures trading. TopStep, prop firm, funded. It's all about intraday futures trading. So that's what we're going to focus on. I also want to mention that the ideas in this presentation are of my own opinion, and they are not to be taken as financial advice of any kind whatsoever. I am just simply sharing my view and my philosophies on trading futures. Next up, here we go, the top five. And forgive me that I am just getting over a cold, so I may pause briefly, momentarily. Excuse me. Number one, keeping it simple. Absolutely. If you've known me at any time or been through any of my webinars or any of my coaching, absolutely keep it simple. I follow the Occam's razor approach. And to simplify that explanation, it's the simplest explanation is usually the correct one. Now, there's a great example that I heard somewhere. It's kind of funny, but I would like to share it with you. And it says, you back out of the driveway and you notice you have a flat tire. So, what are the possibilities? Well, when the circus was a few states away, a whole bunch of monkeys escaped. They stole a plane. They flew into your area, stole a car, went to a hardware store, grabbed a bunch of supplies. One of them was a bucket of nails, and as they were marching down your street, some nails fell out of the bucket, and you ended up driving over it, getting a flat tire. Or you may have dropped a nail from when you were fixing the fence the day before. In other words, I know this is a silly example, but in other words, usually the simplest answer, the simplest explanation is the correct one. And I'm going to explain that into trading because the more we put into trading, the more variables we have, the more we look at, the more complexity we bring to it, the harder it's going to be to make a decision, to get in, to get out, um, and to figure out what's going to make it tick, what's going to make it work for you. So Occam's razor, keep it simple. If you can't explain your strategy to a 15-year-old in 15 minutes or less, it's probably too complex. Yes, I said that. I know that there's a lot going on. I know that there's a lot involved to the market. We can have all kinds of fundamentals. We can have all kinds of indicators like you can see on that chart on the bottom left-hand side there. And that's just a silly image I pulled offline. And hopefully nobody's chart looks like that, but you'd be surprised. If it's too complex, you're just going to confuse yourself. Really, you're going to be looking at too much going on. And I have this rule that says about indicators. First of all, I'm not opposed to indicators, but they should enhance your trading style and assist you for maybe some confluence or maybe some confirmation, but not to be bet on. Say, wow, this average cross here, this oscillator went to here, my RSI is down, my level is this, and just going all in. They should just be there to help you out. Price action is key. Look at the chart, look how the market's moving, regardless of what's making it move, but that it is moving, and then make your trade at that point. Put together a nice simple strategy, and if you can explain it, if you can't explain it to somebody 15 years old in 15 minutes or less, maybe take some indicators off the chart, take some complexity out, and take some rules away. It does not have to be that difficult. The example that I give a lot of times is, let's take one item. Now again, this is not a trading advice. I'm just giving this to you as an example. Let's take one level. Yesterday's settlement price. Pick your instrument, doesn't matter. Let's say we take yesterday's settlement price, which is the same for every trader in the world, no matter what chart type, no matter what chart time frame, no matter which platform, no matter if it's candlesticks, no matter what country, no matter what time zone, does not matter. Yesterday's settlement price is always yesterday's settlement price. It's always the same for everyone in the world. So if we look at that and we say, well, if price is above it and it drops below it, why don't we take a short and manage our risk, take our points, walk away? What if it's under and it goes over? It's going from a bear day to a bull day. Okay, go long. And let's see what we can work out of that. Again, this is a very, very simple explanation because you can look at a couple of things. Did it gap down? Did it gap up? Where's the range at? How's the volume on it? So on and so forth. But just very, very simple explanation. Are we going from a bear day to a bull day or a bull day to a bear day? Bull to bear, bear to bull. Take it, take your trade, put your stop loss on there, and walk away. Very, very simple approach. That's what I'm talking about when I say to keep things simple. Number 3, silence the noise. Remove unneeded indicators and distractions. The distractions may not necessarily be on your chart, but also elsewhere. Maybe there's kids around. Maybe you're in a area that is a lot of people moving around, very distracted. Turn your desk so you're not being distracted looking at something out off in the distance. Phones, dinging of the phones and alerts. Maybe it's too many charts. Do your analysis ahead of time, pick your chart, make your trades. Silence the noise, remove anything in the indicators. My rule is if you don't look at an indicator right before you take a trade for confirmation, take it off the chart. Start with a naked chart, add things to it that will complement your trading style. And then finally, be cautious of conflicting indicators. Oscillators are notorious for being conflicting. RSI, MACD. Throw those two on your chart. You can look at those and say, well, RSI is strong. It's a certain direction, but MACD is crossing, so it's going to be a short. But the RSI is now slowing down, so should it be a long? But the MACD is in the middle, so on and so forth. Take the conflicting indicators off. Oscillators, again, are notorious for that. Bollinger Bands, Keltner channels, they're notorious for it. Moving on. Excuse me. Trade your style. And I should say it this way. Not trade your style, but trade your style. It is said that there are as many ways to trade as there are traders. I am 100% in agreement with that. Absolutely. Just because something works for one person doesn't mean it's going to work for another. It doesn't mean that it doesn't work, it just means that it may not work for you. For example, as I just said, oscillators, moving averages, they do not work for me. I simply don't grasp it. It's not the style that I like. I'm a numbers person. I like certain static levels. highs of day, opening ranges, not much VWAP, but if I was going to use one, I'd use VWAP. Point of control, volume profile, yesterday's, high, low, and close. So I like static levels because they're the same. They're always there. They don't change throughout the day, and it gives me a nice, good base to work with. But that's just me. I'm not a trend person, not a trend trader. I don't hold on to trades very long. I trade NQ. It just matches my style. Trading my way, a way that fits your personality. I am a type A personality, bar none. I am aggressive. I am an Irishman. I'm from New England, the way I was brought up. Uh, I'm an Aries, if you want to go that route. So I have this whole bullheadedness, forward-thinking, aggressive approach to the market. I'm impatient. I want to be in and I want to be out. Doesn't mean scalping seconds at a time. It just means when my trade is on there, boom, I'm into it. Doesn't go my way, I'm out of it. It goes my way, I'm going to take it. Very, very simple. It's very no holds barred approach, very cut and dry, very black and white. It's just the way I operate. It works for me. If you're a person that's a little more patient, maybe you want to try another instrument that moves, I hate to say slower, but kind of swings a little bit more. The golds and oils, silvers, they kind of trend a little bit more and they'll bounce around and pick a direction. Ultra bonds are great for that. They'll bounce around in an area and then once they get out of there and the market starts moving a direction, it generally stays there for a while. If that fits your personality, that's really what you should go after. Forget about what everybody else is doing. Find one that fits for you. I have the little personality types down the bottom. That's from the Myers-Briggs. Go ahead and take that test. See where you fit in. It's a pretty good one. Remember that online traders are influencers and entertainers. I have absolutely nothing against that. There are some great, great entertainment traders out there, great influencers out there, great online personalities out there. Absolutely. Just remember that that their job is entertainment. They don't say anything about it, bad about it, nothing whatsoever. Just keep that in mind. Um, that's all I'll say about that. Stay out of the trade rooms while trading. Um, I don't have anything against trade rooms either because you need camaraderie. You need trading buddies. You want to go in there and share your successes and bounce questions off of others and maybe look for ideas. But when you're in the thick of it and you're trading and you're following your plan, your style, the way you're trading, just stay out. That's 24 hours a day. You can go through those trade rooms and chat rooms and discords and stuff, including the one at TopStep, when you have a break, maybe when you're done. But other than that, focus on your trading. The reason is you may be tempted to break your own plan and just simply jump into a trade because a whole bunch of traders are. They think, wow, this thing really broke out. Well, what if you're a reversal trader? What if you like playing the reversion to the mean and this thing took off? You're like, wow, I'm going to jump on that, take a piece of the action. That may not be your style and you don't know where you're going. It's just a crapshoot. So not while trading, in there for advice and suggestions, absolutely. Finally, there are scores of futures instruments to trade, and there are 23 hours a day to trade them. Okay. Um, there are a bunch of them listed on the TopStep website. You can just go to their topstep.com and the help center in the top right hand side and search for the products or instruments. You get the entire list of them. Try them in your practice account, see which one works for you. They all move a little different. Maybe you're better off at trading grains or cattle, for example, or maybe we don't have forex pairs, but the currencies, the U.S. dollar and euro, the futures products of those. Doesn't always have to be NQ or ES. NQ is by far the most popular instrument in the program. Absolutely by far, like 75, 80% of traders are trading NQ. Behind that is ES, and it kind of has been flipping back and forth between ES and oil at this point in time. What about the Russell 2000? There's 2,000 small cap stocks in there. Once that thing gets on a trend, it tends to move in a certain direction and it's a little less whippy. What about the Dow? $5 a point versus $50 a point. Take it into consideration. And finally, I said 23 hours a day to trade them. Futures markets open 23 hours, but according to the rules of TopStep, we need to make sure we are closed the hour before. So there is realistically 22 hours to trade futures products, and that would be 5 p.m. Central Time until 3 p.m. Central Time the following day. One thing I want to make a mention of is trading the U.S. Open. 80+% of traders are losing in the first 30 minutes of the U.S. Open. So my suggestion is stay away from it. You're not going to increase your winning percentage by 80%. I'm not suggesting that. What I'm suggesting is you increase your probabilities of not losing by 80% simply by staying out of the first 30 minutes. It moves too far, too fast, too wild. There's all kinds of slippage. It's just an erratic. Let that mess go through, especially if you're using some type of oscillator or moving average. If you're looking at the market 15 minutes in the market, even if you're on a 5-minute candle and you're looking at a 20 period moving average, well, that's 20 5-minute candles. That's 110 minutes. That's almost 2 hours prior. So you're 15 minutes into the U.S. market looking at almost 2 hours of the London session. Doesn't make sense. If you want to increase your probability of not losing by upwards of 80%, stay out of the first 30 minutes. You will thank me for it. Okay, number 3, be dynamic. This is a good one. The market is always changing, and you should change with it. I'm going to give you a personal example. I have a pretty good strategy pre-COVID, and my strategy was it looks at the market movement and it just tries to guesstimate and estimate and has a probability of what I think the market's going to do once it breaks a certain level. It should go right in this area. Let's just say it's 10 points. Well, all of a sudden COVID came along and that completely destroyed what my strategy was doing. It was all over the place. So I needed to adapt to it. Now when COVID started slowing down, again, this is 2020, about around March of 2020, and COVID started slowing down a few months later, the market started to return to somewhat normal, but not back to pre-COVID terms. So the strategy I had pre-COVID did not work during COVID, the first COVID outbreak. And then what I did during that section did not work in the post-COVID or 6 months later. So there were 3 distinct sessions of that year that I needed to adapt my strategy for. And this is one thing as an aside, looking at back testing and historical information. Imagine if I used my strategy version number 1 and at the end of the year I said, show me the last year's worth of data. It's going to win 30% of the time because it was horrible COVID and end of COVID. What if I chose the strategy version during the COVID time? It's going to show about 30% win because it wasn't going to work pre-COVID or after COVID. And then what if I chose the strategy that I found at the end or after COVID when it slowed down? 30% of the time, because it's not working. It's not the same as pre-COVID, and it's not the same during COVID. So it's just a pet peeve of mine would say, oh, hey, you got a really cool strategy. Let me download 5 years of data and back test it for performance. No. No, it just being a coder myself and building strategies and automated trading systems and algorithms does not work unless it is adaptable to the market at hand. Like if using something like I don't want to say average true range, but if you're basing your movements off of the market range and the market is being dynamic and sometimes slow, sometimes big, sometimes fast, sometimes a lot of movement, sometimes flying around, sometimes steady. If it's adaptable to that, you'll have a better idea. You'll have a better approach to the market. Being dynamic, also different times, chart times, different time frames. Asian session, London session, US session. Time frames 1 minute, 3 minute, 5 minute, 10 minute, 30 minute. Different instruments. We already said that you may be using an instrument that may not work for you just because other traders are using it. Different seasons being yearly. We have a lot of movement in the indices toward the end of the year where the big companies, especially tech companies, are putting money, taking money off the books. And then you have the summer area where things have slowed down, except for some of the commodities, some sugars and stuff, and the grains. They're still going. They're still moving right along, and same with the bond market. And also different charts. Doesn't always need to be a candlestick chart. There are several different types at Top Step, candles, Renkos, range bars, Heikin-Ashi, volume charts, volume candle charts, volumetric, uh, TPO, right? Time price opportunity. It's the one that Hogue likes to use. And then of course you can just trade right from the DOM. So there are several different chart types. Renko also, in case I didn't say Renko. Um, Take a look at them. They all do different things. And maybe you can have one chart set up. Let's say, for example, you have a 1 minute chart that you're trading off of. Well, maybe take a 5 minute chart and make those Renko candles, not Renko, excuse me, Heikin Ashi candles. So you can see the price action within a minute, but then the overall trending is going to show clearer and cleaner using a higher time frame Heikin Ashi candle type. You may think it's going to be bouncing around and taking off, but you look down at that section you have down the bottom with another candle on there, and they're still red. So it just may be something to consider. A static R and R ratio, risk to reward, reward to risk, whichever way you want to put those two R's is fine. It may not be always be the right choice for specifically for intraday futures trading. Longer term trading, longer hold, swing trading, options, sure. We can take a look at those ratios. Intraday, very, very, very tough. Personally, my risk to reward is far skewed because I take smaller trades and I trade NQ. So if I'm in a trade and I think the market's going to come up here, let's just say, I don't know, let's just make up like 5 points. I think the market's going to take 5 points. Well, on NQ, that's a $100 trade on a contract. Well, if I'm taking 5 points out of it, I'm not going to have a 5 point stop. Why? Because NQ moves 15 points at a time. It just flies up, flies down. I don't want to be entered by a tick or two just to have it go down 15 points, then come right back through my target area. So I'll have a stop loss on there, always have a stop, but it's going to be further away. Doesn't mean I need to let that stop loss get hit. If the market doesn't do what I want and doesn't get to my target and looks like it's starting to turn around on me, close the trade, get out of it. If it pops up and is getting close to my target, doesn't quite reach it, close it anyway. It's not that you're leaving money on the table, and it's a phrase that drives me crazy. You took money off the table. If I'm on a 10-point trade and it's at 9 points, I'm closing it. It's all done. 8.5, 8 points, especially if it starts slowing down a little bit, it's just my style. Once it goes to a certain area, I think it's going to blow through the next area. If it pops up and starts hovering and starts doing one of these, nope, I'm out. I'm not going to let it go all the way down to my stop. So even though my reverse reward risk ratio is like generally around a risking one, risking 3, reward 1. So if I'm looking at 5 points, my stop is going to be 15, 20 points away. Doesn't mean I let it hit it. So again, static risk reward ratio may not be the right choice. Sometimes it is, depending. Oil is notorious for that. If you can, you know what you're going to risk on there, throw your risk on there, and then let it run. Perfectly fine. Experiment with different strategies without strategy hopping. Looking at different strategies is totally fine, but do it on the off hours, not while you're trading. We don't need to bounce back and forth. Secondly, like we said in the previous slide, is find something that works for you, for your personality. If you're trying something and you use it for 3 or 4 days and you go, this is crap, this didn't work very well. Well, maybe it just didn't work for those 3 days. Need a bigger sample size than that. Scale down, maybe even switch to your practice account. We're not in a race here. We're not in a rush. The key is to get good, get a strategy that works for you, consistent over and over and over again. Doesn't mean you can't look for another strategy, but play around with that in the off hours. Do market replay. Try it out. Take time and context into consideration. That's a big one too. This is all into being dynamic. If I have a strategy, just whatever it is, I'm not gonna name it, just whatever my strategy is, and I'm looking at it on a 5-minute time frame. What if I go to 15? Is it the same thing? What if it's an hour? Let's just say the market comes up and it bounces off a little bit and it comes right back down again and it's an hour candle. Well, if you go to 30 minutes, maybe it hit the top twice. If you go to a 1 minute, maybe it hit it 12 times. So take time and context of the market movement into consideration, then adapt from there. If you're looking at a strategy on a certain time frame chart or a certain chart type or a certain instrument, it's most of the time, majority of the time, it is not transferable over to something else. We can't just take a strategy that you've been trying out on NQ and be like, oh wow, this is a little fast for me. I'm going to take this and move it to ES. That's an entirely different instrument. They're close, they're indices, but they move entirely different. Price point is different. Price movement is different. It's NQ has 100 stocks in it. ES has 500. It's a thicker market, moves slower, less activity, less volatility. So just those top things, especially if it's in after hours. If you're trying to trade the ES on an overnight session, good luck. There's not much movement there whatsoever. So take that time and context into consideration. Okay, 2 more to go. Number 4, managing your risk. 100% of trading is risk management. Yes, it is. If you are unable to manage your risk, you're out of the game. It is that simple. It is that easy. Nothing to it. If you can't control your losses, you're not going to have funds to work with. It's not how much you make, it's how much you don't lose. Kind of goes hand in hand. I pulled that quote offline somewhere back in the day. I don't 100% recall, but it's a very, very good quote. It's not how much you make, it's how much you don't lose. And that's all falls under risk management. I like this quote from Mark Douglas on here. It's from Trading in the Zone. It's the hard, cold reality of trading is that every trade has an uncertain outcome. The reason I put that in there is because we cannot control what the trades are. We have uncertainty. There are only 2 things that we know for certain. 1, our entry point. Why? Because we entered it. We know exactly where it is because we chose to put it on. 2, what our risk level's at. That's what we can control. We can control if we hit it or not, but we control that if we hit it, we control where it is. That's how we can manage our risk. We know we enter, we know what we're willing to risk on that trade. Do not add to losing trades. I cannot stress this enough. Do not add to, forget the dollar cost averaging down, whatever you want to call it. And for those who don't know, this means, let's say I'm going long and the market goes against me. And if I add another position, it only has to go halfway back to my original entry for me to break even. But if it goes against me, I'm now losing at the rate of 2 contracts. And then when I go in again, I add another contract. I only need to go halfway back to that halfway back for it to break even. But now if it doesn't, I'm losing at the rate of 3 contracts. Seriously, do not do that. Martingale is close. Martingale is doubling each time. So 1 contract, you go to 2, then you go to 4, then you go to 8, then 16 that way. But if you just keep adding to it, hoping it's going to come back, no. There's no need for it. There's not enough room. There's not enough room in the accounts. We need to preserve capital. There's not a 50K account. You have a $2,000 loss limit. So think about that. If I put $50,000 in my own account at my own personal broker, I can lose $50,000. But a 50K account in the valuation is you can only lose $2,000 before you lose the account. So that means it's really a $2,000 account. I'm not saying it's like trying to pull a fast one here, but it's just based off of leverage because the $2,000 account is where they're willing to give the amount of risk. Trade it as if you have a $2,000 account. If you have a daily loss limit of $500, you're losing 25% of your account in one day, and you're okay with that? I think not. Probably should scale down and have a little bit tighter risk management on your side. Along with that, there's no need to hold and hope through a drawdown. And again, this is your intraday trading. I'm not talking long swings or options or anything like that. Hold and hope is, let's say I enter a trade and I think it's going up and it ends up going against me. I'm not just going to hold on to that and hope that it's going to go up. Again, first of all, we don't add to that losing trade, but we also don't need to hold on to it if it's not going our way. There's not enough room in these accounts, folks. There's not enough drawdown room for a lot of drawdown. If it starts going against you, get out. You have every right to close that trade and then re-enter right above or right around where you get out of it once it starts falling away or if it starts going your direction. There's no need to hold on to it. So let's say that example. You think the market's going up. You enter and it starts going against you. You get out. And then you put another entry on right above it, waiting for it to come back around. If it does come back around, you haven't lost anything. Congratulations. If it doesn't come back around, you just took a nice small stop. Save your capital, manage your risk. That's the way it works. Finally, accept that there will be losses. Absolutely. You could have the best baseball player in the world, they strike out from time to time. The team that won the World Series had losing games along the way. Just accept them. If you keep them managed, keep them small, uh, you're not going to be able to control a loss, but you can control how much you're going to lose. Keep them small. Get out of the trade if it's not going your way, uh, and keep your ratio the way. But meaning if you're not going to, if you're targeting $50, you're not going to want to risk 200 for that. And like, I'm going to take my stop off 200, take my trade off, and I'm down 200. But if I'm going to take $50, I'm going to pull that off. You got to kind of flip that a little bit. I'm not saying, like I mentioned in the last slide, that you're not going to have your stop further away potentially, just as a failsafe. I'm saying your winners and losers. You want to keep those winners up there a little bit more. Just get out of losers. We're talking managed risk here. Get out of the loser. Save your capital. Okay, one more to go. Keeping emotions in check. I quoted Mark Douglas there from this book that you see on the screen from Trading in the Zone. Um, it's a pretty good book. I've listened to it on audiobooks maybe 4 times now. There's one little section that gets a little dry, so I fast forward past that a little bit. But it is really good. It's all about here. Trading is all psychological, as we see on the screen here. It's nothing but human emotions plotted on the chart. The example that I use for this here is, let's say we're looking at Apple stock, for example, and they have bad earnings, and there's some type of scandal with the CEO, and the financials are down, and they have a product that failed, and they had to walk out of the company. Just things were not going right for the company. If nobody sold, the stock doesn't move. It's when people panic. It's the human emotion, the psyche side of things. They say, "Oh boy, I don't know about that," and they sell. It's gonna drop the stock a little bit. Someone else sees the stock dropping and say, I'm uncomfortable, it's starting to fall down. Let me just take my profits out right now and get rid of this. That's going to push it down further and faster. And other traders go in there, and other stock shareholders will say, like, the heck with this, all this bad news. You can already see it stop. It's dropping. I'm going to get out now, which drops further and faster. And then all of a sudden you see the short sellers come on, and they start shorting it, which drives it down further and faster. That's all human emotion. Bad press did nothing. A bad product did nothing. Bad earnings did nothing. It is the human element that moves these things around. Learn that, understand it, and also understand your own psychology, where if you can see the markets moving that way, see how you feel about it. The reference in here for Trading in the Zone about the dog is great. I equate that to taking bad trade. First time you met a dog, maybe you had a great experience. You like dogs from that point. You can meet the next 8, 9, 10 dogs, no problem. And then you come across a dog and you get bit, you get nipped at. It's like, that's okay. It's a one-off dog. But what if the first dog you ever met bit you? From that point on, you're completely biased. Like, am I going to get bit again? You're hesitant, right? That's the psychology side. One dog has nothing to do with the next, especially if you were young. If you're 5 or 6 years old and you got bit, and the next time you met a dog, you were 15. One is not related to the other, except we keep that in our minds. That gets buried into our psyche, just like trading. You get that bad trade, that really bad day, and just something did not go right. You start thinking you're a bad person. No. It's just a bad trade. It happens. Losses happen. Pick yourself up, dust yourself off again, get right back into it. Make the necessary adjustments. It's all up here. You can do it. Sim versus live button. This is an idea that I had. We're going to take your platform, and you're going to trade. But on the back end of it, randomly throughout the day, I'm going to click it over to live or click it over to sim. But you don't know. Anytime throughout the day, the whole day, or 2 days, whatever it's going to be, randomly over the course of the week, I'm simply going to turn your platform into evaluation mode or sim mode, or into live trading mode. You're not going to know about it. I will guarantee you that you will do better. How many times I've done it myself? We do great in our sim account for practicing, and then we go over to the combine and we say, "Oh, I didn't do so well," and why is that? Market didn't change. You had the same thing. It's all here. Okay. I would love to have something like that. Maybe I'll make it. It would be pretty cool, or just have it in the background, randomly switching back and forth between logging into eval and not. It'd be pretty cool to try out. What you do outside of trading does have an effect on your trading. This is true. Are you tired? Are you hungry? Did you have a bad day the last couple of days? Are you stressed for something in home life, something at work? Are you in a hurry because you had some place to go? You want to hurry up and get that trade in because we want to go and the market opened up and you only have a certain amount of time. All of that stuff can affect your trading. Definitely rest. Rest is great. Nutrition is great. Uh, Keeping that water going, keeping that focus, keeping the distractions away, and exercise. Make sure you're staying healthy, rewarding yourself, taking care of yourself. It's going to make all the difference in the world. Okay, well, thank you very much for listening to my spiel here. I'm going to move this over. Summarize, we want to keep it simple. Occam's razor approach. Trade your style. Don't worry about what's going on with everybody else. Be dynamic. Markets are always changing. Change with them. Adapt it. Manage your risk. Manage your risk. Manage your risk. Manage your risk. And finally, keep the emotions in check. That's the hardest part. Trading is nothing but human emotion on green and red candles. Well, I hope, thank you for watching this. I hope it gave you a little bit of insight into my approach to the market, some of the trading philosophies that I have. I look forward to working with you either on Tops Up TV or in groups in Discord or in my channel. I look forward to it very much. I'll be having some more of these as well. As we say at Top Step, trade well and always trade for tomorrow. Thanks again.